Hi everyone, this is Rob Roy, and welcome to the Elliott Wave Elite U.S. Market Update. Getting to the charts, boy, what a wild Tuesday in the U.S. markets. I'm sure everybody is aware by now. The S&P, the cash index, finishing down over 90 points. Lots to talk about, so I'm going to go relatively quick to keep this from being a super long recording. But last time we chatted, we talked about how there was the possibility that this zigzag pattern that had completed itself, so perfectly go back and watch past recordings if you want to see how that played out. Instead of that just being the completion of a pattern, was that a complex A wave? Because we had this 61.8% correction with the doji, and then this could be the start of the C wave lower. Well, what happened was that became disqualified. As you see, we moved up past the 61.8% level right here, all the way up to 78.6. So that disqualifies this pattern as a C wave zigzag to the downside. So now we know what actually happened out of this pattern, and it's very classic Elliott Wave action, where we have this completed zigzag pattern, just spot on, and then we move into following a directional impulse pattern, which, remember, a zigzag pattern is a directional impulse pattern, and that was the 100% extension on the C. We moved into a flat. That happens quite often, that you will go into some sort of a consolidation following the completion of a directional impulse pattern. Sometimes it's a consolidating triangle. In this case, it happened to be a flat, and it's a very, very classic one. I don't trade flats personally, but you need to be aware of them for situations like this. And not only did we have the completion of the flat that occurred on Monday, there was a doji. So we have this sideways flat pattern and a doji that occurred on Monday. Now, there was a big gap up in the chart. If we go to the SPY so we can bring volume in, there was a gap up in the chart on Monday's trade following the meeting with Trump and the Prime Minister, a Premier, I should say, of China, and the chatter of they had agreed that they were going to pause their trade war, and Trump made it sound like it was this wonderful meeting and all these good things were happening. And so the market actually gapped to the upside on Monday's trade following that announcement. So we have this little gap here. So the likelihood was there that in today's trade we were going to go down and fill that gap, or very soon we would. Gaps always get filled. In the markets, they usually get filled fairly quickly. On individual shares or stocks, sometimes it takes a little bit longer, and that's the hard part, is to know when the gap's going to get filled. We just know it will get filled. Well, we started to the downside, and once the gap was filled, it was okay, because I was chatting with some subscribers and stuff of what's going to happen now, and what happened was something we talked about way back over in the summertime, and that was the yield curve. There was an inversion in the yield curve. This green line, the bottom line, represents the 2-year Treasury, and the blue line up there represents the 5-year. And this is actually from the U.S. Department of Treasury's website. And you can see that they crossed over here at the far right. The bottom line, that black line down there, is the difference between the two, and the horizontal line at the bottom where the months are is the zero line. So it actually broke below the zero line, meaning that there was a negative difference, meaning that we had an inversion where the 2-year had crossed above the 5-year. Now, a lot of people get confused about what an inverted yield curve is, what it means. Well, what it means is very significant, but let's talk about what it is first. What it is that when you buy a treasury or a bond or whatever, and you buy a longer maturity, you expect to earn a higher rate of return, right? Because you're committing to owning it longer. So if you were to go buy a 5-year treasury note versus a 2-year, you would expect to earn a higher rate for the 5-year. And if you look over here on the left-hand side of the chart, you can see where the difference was. going back to December of 2017, there was a separation there. So if you bought a 5-year note, you made a little bit more interest. Not a whole lot, but more, which you would expect because you're committing to own it. Now, it doesn't make any sense, does it, when they invert? Because basically what that means is that you could earn a higher rate of return to buy a 2-year Treasury note versus a 5-year. And so that doesn't make any sense. And historically, 11 out of 11 times when the yield curve is inverted, it's forecast a recession in the U.S. economy 9 to 12 months out. And the market looks 9 to 12 months out. We know that historically. So all of a sudden, the bottom fell out of the market once all that news was coming out that we had an actual inversion in the yield curve. And now all the pundits are out and they're talking about, well, there's this going on, and they give you a whole bunch of technical reasons of why there could have been an inversion. And the phrase that when you hear this, it's different this time, it's not different this time. It's something that needs to be paid attention to. It's a warning sign. Now what we'll have to do is see what happens. The markets will be closed tomorrow on Wednesday in a day of mourning for the death of former President George H.W. Bush. They're going to have his funeral tomorrow, so the day of mourning, and no markets. The markets will be closed, so we won't trade again until Thursday. But with this drop, we didn't drop a whole lot below that 10-day moving average, which is fascinating. So again, we had good separation here. The likelihood that we were going to move down, fill that gap, was there. But the move to the downside certainly caught a lot of people by surprise. Now, when you drop that far, are we going to snap back? Are we going to bounce back? We'll have to wait and see. A lot of people were talking about the VIX today. Now, remember, the VIX and the Elliott Wave is in sideways correction as well. We talked last time about this symmetrical triangle that formed, and in this case it's very interesting what has occurred from here, because now we will reset this based on the action from yesterday and today, and now we have this support level right here around 16, which we've been talking about for quite a while, as well as being the new support level. Used to be an area of resistance, and now look, we have these lower highs on the VIX. So we have a descending triangle that's in the works, which is a larger pattern than the symmetrical triangle that we had previously. Now we need some more work to make this a pattern that legitimately will break out. In other words, a little more back and fill through here, maybe a little calming down in the market to bring the VIX down just a little bit. But we'll see. With this big spike in today's trade, what happens on Thursday, we could blow out through there very easily. Haven't shown you a chart of the dollar in a while, so we thought we'd bring that up. We've had that wave 5 high, and now we're going through consolidation, and this is what I was just talking about as far as the market itself. When you complete an impulse pattern where you go into a consolidation, and you can see right here that we are in this symmetrical triangle following that wave 5 high. Now, are we going to break to the upside and set a new wave 5? We'll wait and see. Or the pattern could end at that fib level there that coincides with the wave 5 high. A stronger dollar would be better for the economy, but if we are going to look for a recession, we could see the dollar weaken a bit. There's a lot of stuff going on in Great Britain right now, and that certainly was affecting. You can see that the dollar was weaker, and then it came back and rallied back to finish basically flat on the day. But that has to do with a lot of stuff that's going on over there with Brexit and everything else. Looking at our case studies with TBT, we had showed you this symmetrical triangle that we were trading. The wave 4 has come down and it's violated the last fib level that I looked for. The 61.8% level has been violated, so that pattern is nullified, and we revert back to the triangle pattern that we had, and this strangle is now profitable with that big breakout to the downside. So there's a drop in the rates, and this is on the longer end here, which adds into the inversion because this is on the 20-year. Remember, TBT is reflecting, it's an ETF on the 20-year. So here you can see how the rates fell on the longer-term maturities, and with the 2-year, pardon me, maintaining, we had that inversion or that crossover. Very fascinating chart on MasterCard. Last week we talked about how we had come down to this first fib level at 38.2% level, and then look how we went rocketing to the upside back in this wave 5, and this had been a star. Today we did come down and fill the gap, but greatly outperformed the market today, obviously, but big move to the upside. Look at the 10-day moving average, and you can see that following Monday's trade, we were overbought. Remember, no security in any time frame gets very far away from its 10-day moving average, so that's why we always look at that. So there's separation there. We were due to come back and calm down a little bit, but this trade is looking really strong now. In fact, we broke out on the close on Monday above the highs that we had back earlier when we had originally put on the position. So that's looking good. The Unilever strangle has yet to break out. Remember, we got the consolidation patterns again following the completion of wave 5 up there. So we have this very nice triangle formation, broke out, came down and tested the level, and it was trying to break to the upside today before the market all fell apart. But this is a little bit more of a defensive-minded company, so it could outperform if the market is going to weaken. We'll see. And then, isn't this fascinating? The ones that we showed that even in the weak market, our search, the customized search that we created within Integrated Investor using not just Elliott Wave, but on fundamentally healthy stocks. Look at this on the earnings report today. Blew to the upside on this wave 3. That trade's a home run. We close that out. So just take the gains on a huge update today. Finished up 55 points, was up more than that earlier in the day. It's been a wave 3 the whole time, and the wave 3 continues. So that amazing. I mean, the Elliott Wave is amazing, and you have the perfect tool here in Integrated Investor and Profit Source to identify these. And then look at Clorox was the other one, and that one went up. Now we're at the 68% level there, which is above the 61.8 a bit, but it went higher when we set our butterfly up here, remember, expecting this to move from where it originally was, which was just touching this wave 5, up into this area. And so this one finished. This one wasn't a home run with the butterfly because it got there in a week or two, but still a very nice return on the trade. And just fascinating that in this craziness of the market that we've had up and down here, these two have just continued to power forward just like they were forecast to do. It's almost like they were ignoring the rest of the market. Fascinating stuff, but really two fantastic trades from previous recordings. And then the new one for this week is going to be on Pinnacle West. This is a utilities company, so it's a defensive-minded one for those of you interested in fundamentals again. And when you have weakening economy, people are looking to take less risk with the high beta names. Money tends to move into more defensive-minded stocks, and a utility stock certainly fits that bill. We're in a wave 3 to the upside. We did have a pretty decent day underway. As you can see that on yesterday's trade, we closed right there, just right above this little resistance area, and then we had broken above it and came back down and closed just above it in today's trade. So still only finished down 14 cents on a $90 stock, with the market down 90 points on the cash index, the SPX. So I would say that's pretty good performance there. Again, greatly outperforming the market. So the fact that this is in a wave 3 certainly looks like we are in a period of time where maybe the economy is going to weaken as money seeks out safer havens. And notice this really nice zigzag pattern here in the wave 3. They're everywhere if you know what to look for. Fascinating stuff. that wraps things up, gets you caught up. Again, markets will be closed on Wednesday, and boy, is Thursday going to be interesting. The end of the week, Thursday and Friday's trade, and we'll be back over the weekend to bring it all to you. Take care, everybody. Talk to you soon.